I have the pleasure of introducing a keynote speaker. He perhaps needs no introduction. His firm has a very broad vision of what they want to do in emerging market private equity, and he's already a veteran in this space. He is a strong partner for IFC. Let me introduce now the group executive and CEO of the Abraaj Group, Arif Naqvi.
Thank you. Good morning. It's nice to be amongst so many friends and see so many familiar places. I have to say, Maria, I cringed a little bit when you mentioned that it was the 18th year that this conference is being held. It told me a little bit about my age. So I actually have to commend both the IFC and MPA for continuing to hold this conference and to continue to grow its stature and scale, because this really is the foundation where all of our various participants across the industry come together and have a chance to talk to each other and exchange notes and really see where this industry is going and to try and project a little bit around the trends for where we see it going. I'm not going to take your time in having a long discourse on how great private equity is or how wonderful the opportunity is. I'm going to leave you with a few thoughts on where the opportunity potentially could be going, and more importantly, why we should all be walking out of this room today with a spring in our step, because the opportunity really is continuing to scale very interestingly despite what you hear in the headlines. Now, this is not a time to be listening to the headline hysteria and the naysayers about our markets. I'm here to tell you that the markets in which we invest continue to be the drivers of global growth in a manner that is often not reported. I'm here to tell you that the opportunities in those markets, carefully selected, will deliver and continue to deliver disproportionate return to your investors. And finally, I'm here to tell you that the risk of investing in these markets is often misunderstood or overstated. And within that context, I'd like to paint a picture which should leave you feeling very good about the state of our industry. I'm going to say right here and right now that what all of us share in this room is an unshakable belief that global growth markets, which is my term for emerging markets, and I'm sorry, MPA, but global growth markets is where the opportunity is, because, and I feel strongly about this term, because by no means are these markets continuing to be just emerging. And they have a leading role in the global world economy as well. They don't follow other markets. They're undisputably key markets today and will continue to be so in the future. My own personal experience informs this belief, as it does for quite a few of you as well. Actually, for the vast majority of you. That's why you're all here. And together, I hope that we'll emerge from these 2 days with a reinforced conviction and a clear understanding, backed by facts, that our markets are crucial for the future, not just for the PE industry, but for the global economy. And that's why in these markets, we're at the forefront of innovation as well. As Philippe just mentioned, there's some great things happening out there. Impact capital, infrastructure innovation around investments. Indeed, the whole hypothesis around partnership capital and long-term capital is being defined in these markets and is going to get increasingly adapted in the West as well. That's why the sometimes binary view as to what's happening out there is a little bit difficult to swallow. As I'm talking, by the way, my colleagues told me that a lot of you like facts, so there'll be some statistics flashing up on the screen. I'm just going to keep talking. I hope that the statistics keep pace with me. No doubt, it's a very complicated world that's out there. It's marked by uncertainty, not the least of which is the fight to see who moves into the house down the street in a few months' time. You stand on the verge of nominating a presidential candidate with mixed political experience and a stubborn worldview. And then, on the other hand, you have Donald Trump as well. You have political leadership in our markets, which is very confusing and complicated, and indeed, global uncertainty where we live is now part of the story on how the future is going to play itself out. Political leaders across the globe are threatening populist responses which only promise to aggravate political uncertainty and economic anxiety. Politics is proving to be a source of concern, not hope. We should not be overly sanguine about geopolitics, but it's very nuanced. The unintended consequences of globalization are now upon us. But if we're going to be successful, we have to favor the nuances over the naive. And I'm going to spend a little bit of time talking about them because it's important in our industry to see what's out there in the context of how we're going out and investing as well. Because when you go out to meet the other half of you, which is the GPs and the LPs, the first question is, but amongst this uncertainty, why should we continue to deploy capital? And therefore, the overriding characterization that I have for the markets out there in the past year and in the coming year is actually uncertainty. But the question I often ask myself is how much of this is driven by hysteria, by headline hysteria, and how much of it is the need to actually aggregate news. So let's start delving into the nuances, and let me start with this very clear understanding that uncertainty is dominating the current discourse. It's being driven by a number of factors: geopolitics, mixed economic indicators, and domestic elections across the world at the top of the list. Geopolitics by themselves paint a very grim picture. We still have nihilistic extremists like Daesh or Boko Haram who continue to commit barbaric violence in the Middle East and Africa and increasingly beyond those borders. We have Europe, which is at a crossroads. It's no longer about the Greek crisis. It's about Brexit. It's about refugees. It's about the stimulus that doesn't seem to be working in the industrial heartland of Europe. And when you look at the markets, financial and economic uncertainty are approaching new heights. Equity markets are jittery, the Fed is under global scrutiny, and seems to be caught in a damned if you do, damned if you don't sort of situation as well. Oil prices continue to remain depressed, slightly confusing, and while OPEC producers favor $50 a barrel, they're unable to agree on how they're going to get there. And China's slowdown is regularly reported with much glee by the media on a daily basis. In multiple Western economies, there's real anxiety that young adults are poorer than retirees. And this is a trend that we haven't seen before. And it's interesting to dwell on that for a second, because when we sent our children to universities, our generation, we promised them a future better than ourselves. And yet, when they emerge, the level of graduate unemployment has never been higher than it is right now. So there seems to also be a breakdown of the social contract between the young and the older, and that in turn has also led to a lot of innovation, despite our not realizing that, around what we see on social media. Inequality is increasing as well, and in some countries dramatically so, for example in the United States. And the latest economic indicators from here are showing that even as job numbers are going up, productivity and wages are coming down. And all of these matters, by definition, raise our anxiety. So that was the bad news. It only took 8 minutes. I still have a lot to talk about. And uncertainty, however, does not change some very, very important and undeniable fundamentals. If you focus on uncertainty, it's very easy to get worried. And it's important to place it on the table and talk about it. So we've done that. Especially if you're sitting in an advanced economy, and especially if you are serious capital and you're reading, listening, and watching all that uncertainty that is out there. And then if you're an emerging market investor, you add in the mix of the fear of a strong, an overly strong dollar illicit, and you start to form knots in your stomach, clearly, and you think that the opportunity has long passed. But I don't think, actually, that that opportunity or our future is defined by those parameters. I mean, every year there's something or the other that's out there, and every year we continue an inexorable march towards progress. I see the opportunity and our future defined by the inevitable and undeniable growth capacity that exists as well in our markets. That's going to be the hallmark of investing in growth markets in the next decade. And let's focus on that. I'd like to focus on a few of those fundamentals that I am convinced point to a secure future, at least for everyone in this room, as we chart this and navigate this route ahead of us. We cannot ignore the macro, and all that discussion about uncertainty was meant to reassure you around the fact that it needs to be looked at. But looking through it, we don't need to be owned by it. Such is the nature of private equity. Two very, very clear trends drive my positive outlook about these markets, and they are urbanization and demographics. Ladies and gentlemen, these trends are clearly here to stay. They cannot be stopped. They exist. Whether the Fed raises interest rates, whether the EU falls apart, whether tensions in the South China Sea implode or escalate. Ultimately, these two trends, simplistically speaking, alongside many others, combine to shape the future of the global economy and should shape our perspectives as well. The global economy is clearly shifting east and west. Our markets, the global growth markets, already make up half of global GDP on a PPP basis and are projected to be 2/3 by 2030. Global growth markets are going to dominate just about every trend that we can think of in terms of macroeconomic indicators in the medium to long term. That's just a fact. 2/3 of global trade is going to happen up until 2030, and increasingly South-South trade amongst our markets. 2/3 of consumption growth in the next 2 decades or decade and a half are going to happen in our markets. Young, urban, middle-class consumers are the ones that are fueling growth, as Philippe just mentioned. Rising disposable income, which is going to be combined with historic underinvestment, is going to combine to create real opportunity for development across that world. And this demographic and urbanization trend is driving the emergence of a new, a very different, and a very dynamic world order. Let's focus on demographics first. One of the greatest achievements of the 20th century, ladies and gentlemen, was a dramatic rise in life expectancy, especially in the West. And whilst that's truly remarkable, the flip side is that developed countries now face a host of issues that they never thought they would, which are associated with aging populations, increased healthcare, pension spending, lower dependency ratios. And as the West grows older, select markets across the world are set to benefit from a massive demographic dividend in the coming years. The median age in sub-Saharan Africa is 19. It's 27 in Southeast Asia. It's 35 in China, and it's 40 in the OECD. What happens when you're 40? You start worrying about the specs you wear, you start worrying about healthcare, you start worrying about pension benefits. The things that drive you are no longer the things that drive you when you're in your 20s. When you're in your 20s, you want more of everything. You want the motorbike, you want the jeans, you want the apple pie. And because of all of that, and also you want debt because you don't think about tomorrow. So there's the negativity and the positivity. These demographic trends are going to reshape the composition of the world's population. 2 decades from now, there's going to be 10 billion of us living on this planet. Only 13% of that number is going to be residing in the developed markets, and 25% of that number is going to be coming from Africa. And by the end of another few decades after that, Asia and Africa are going to compose 80% of the world's population. Now, it's easy for me to flippantly say a few decades, but the reality is, in the next 30 to 35 years, what I have just said will come to pass. There is absolutely no question about that. And this matters to the world that we live in, that you live in, because younger populations, by definition, are going to be associated with increased consumption. They're going to be associated with increased availability of cost-competitive labor. And in the course of the next just 10 years, middle-class consumption is expected to grow by 4 times in global growth markets. That's an astonishing number. This is going to imply a shift in the geography of consumption and the geography of manufacturing. Please think about the terms I just used, the geography of that, because that means that there is going to be a tectonic shift in the way in which we look at business. 1 billion people are going to be moving into the consuming middle classes in the next decade, most of them in growth markets. Take India, for example. Every month, 1 million young people are turning 18. They expect jobs, they expect access to goods. Now, park all of those stats on one side, and now let's talk about urbanization. Mankind is becoming, or has become, in the last 3 or 4 years, an urbanized race. More than half of us live in cities. There are now more people living in cities than in rural areas. And soon, 2/3 of the world's population is going to be living in those cities. McKinsey, a favorite source for statistics, says that about 430 cities are going to be driving, again, around 70% of global growth. And interestingly, for the first time in recorded history, Bain and Company and McKinsey agreed on that statistic. Developed markets are already largely urbanized, as we all know. And the urbanization trend that we're witnessing today is actually largely, in both absolute and relative terms, a growth market phenomenon. Lagos alone is expected to grow by more than 500,000 people a year over the next decade. 9 of the world's 10 largest cities are going to be located in these markets, including Karachi, Delhi, Cairo. And only Tokyo, from the developed world, is going to retain that elite top 10 status. I don't know if it's elite, it's all a function of how it develops, but that's the only one that's going to be out there. Cities, without doubt, are the economic engine of the modern world. As a rule of thumb, and it's an important and interesting statistic that I learned, as a rule of thumb, a 20% increase in a country's urbanization rate is going to double the income per person in that country. And cities in global growth markets are now driving global GDP growth. So city growth rates are far outpacing national growth rates. And if I could take the license of being up here and painting a broad brush, if Indonesia is growing by 4%, you can bet your bottom dollar that Jakarta is growing at 8%. The same thing holds for Istanbul in Turkey. The same thing holds for Mexico City and Mexico. That's just the way in which urbanization has happened. And yet there is the development of new cities as well at the same time that is going to lead to a more balanced growth. And what we see playing out in these markets is not very different from what we witnessed in the West in the 1950s. A rapid rise in urbanization coupled with an increase in consumption and wealth. The only difference is that it's happening with us at a far faster speed and on a much bigger scale. The world is undergoing an economic, social, political, demographic, and physical transformation. And global growth markets are not only taking on a larger role, that role is going to continue to increase as well. So I hope that sort of summarizes for you, in overall terms, that I'm an unabashed believer in these markets. Guess who's already picked up everything that I'm saying and translated it into EBITDA and bottom line? It's not just me who's a believer. The Procter & Gamble's, the Unilevers, the Nestle's, the Coca-Cola's, the Kimberly-Clark's of the world have picked this fact up. Disaggregate any of their earnings statements we have, and you will find the majority, if not all, of their profits are coming from our markets. And if you further delve into their numbers, you will realize that the rate of growth and investment in our markets outpaces their investment in developed markets by a ratio of 4-to-1. So that, if you like, is where the scale is. Now let's talk about these markets. What are these markets? I've never been a believer in acronym-based investing. I could never understand the concept of BRIC other than the fact that it made Goldman Sachs a lot of money. Brazil and Russia don't have too much in common with India and China, and yet it was interesting to see that. Let's disaggregate the term of acronym investing and see what our markets actually represent. So I tend to look at the world of emerging markets in 3 buckets. China on its own and separately. I look at commodity-oriented countries as a second bucket, and I look at private consumption-driven economies as a third bucket. Let's talk about China to start with, and quickly, because we all know a lot about China. It's important to remember that a slow China is still growing 2.5 times faster than a fast US. We often forget that we aren't talking about a contraction or a stagnation here. We're only talking about decelerating growth driven by structural changes in their economy that almost everyone would agree are important and needed for long-term stability. Some of the world's best economists live in China. They don't talk about it much. Mostly the view on China is expressed by economists from outside China, but the reality is they do know what they're doing, and they have made pretty clear that the shift towards a consumption economy has started from an investment economy. The recent volatility in Chinese stock markets is not a good proxy for the economy because historically there's never been a correlation between China's growth and the Shanghai Composite. The Chinese stock market is small when compared to other countries, as are the spillover effects of the equity volatility into China's economy. And furthermore, Chinese households hold a very small proportion of their financial assets in stocks as compared to, say, for example, the United States. China is actually about two different economies. The old one is based on industrial output, and the new one is based on services, and is starting to become consumption-driven. The old one is looking about China through the lens of Foxconn creating a factory. The new one, which churns out iPhones, the new one is about the long lines of people that are outside the Apple store clamoring for the latest device. If you look at China's service sector, then things are not as bleak as within their borders as they are outside of them. Millions and millions of companies, mostly concentrated in tourism, healthcare, sports, and education, were formed in 2015. Wages, which are growing at more than 10% annually, are driving consumption, and contrast that with developed markets where wages are stagnant. I won't deny that if China's industrial sector falters, it may have negative impacts on the rest of the world, but it's hard to deny that a middle class in China, driven by increased consumption, will definitely offset some of the negative. So that's the first bucket, that's China. The second bucket is the commodity-oriented economies. These are the real sufferers of the recent EM slowdown. For example, Brazil and Russia are expected to contract. And beyond unfavorable commodity prices, both economies have seen severe macroeconomic issues as well. They failed to leverage the commodity supercycle to prepare the economy for tougher times. Countries that are dependent on China, on exports to China, such as Angola, such as Zimbabwe, have also been especially hard hit, but they suffer not just from reduced trade, also from reduced FDI, which tends to be quite closely correlated as well. But even within this category, we need to differentiate. Some traditional commodity-based exporters, such as the UAE, have diversified fantastically, and that is a case in point. When oil economies back in the 1970s at the founding of the country were 90%. Today, they're 30%, and that number continues to go down. The GCC oil exporters have large reserves relative to others, and whilst they are coming under pressure, we're also seeing some fairly constructive, productive, and positive responses coming from countries like Saudi Arabia, which are planning to aggressively diversify their oil wealth. And although this may signal tough times, ultimately it's an initiative that will present very long-term benefit to their citizens. So let's come to the last category that I deliberately kept to the last, which are the private consumption-driven economies and countries. These are relatively insulated from fluctuating commodity prices, with lower prices actually resulting in a stimulus, in increased disposable income, and consequently a facilitation of growth, and a China slowdown. So these countries, unfortunately, in my book, receive far too little EM, inverted commas, attention in the media. The average percentage of GDP growth in these economies attributable to private consumption is 60 to 70%. 60 to 70% versus 43% in the BRICS and 34% in China. Consumption, ladies and gentlemen, in these economies is a very resilient story. We see a growing number of citizens in these countries with increased wages, disposable income, who are all consumption-driven. The inequality gap, the gap between concentrated wealth and those in the middle class, in these markets is smaller than you see elsewhere. But sadly, it's also going in the wrong direction. The middle class in the rich world have seen their incomes flatline as well. In our markets, this gap is larger, but moving in the right direction, with the middle class seeing gains, although not at the speed that we would like them to see it at. So let's look in overall terms at what the PE opportunities in our markets are actually going to be. PE in our markets, as everywhere else, is about micro in every respect. It's not about macro. We invest in companies, not in countries. And in reality, we invest in specific management teams that help drive value or growth or opportunity or impact in the specific market in which they operate. In terms of investment, the opportunity continues to remain the same as it was before. It's as ripe as it was before. But of course, translating those opportunities into returns is far from easy. That's where the alpha lies. And how do we do that in our asset class, and what are the real risks of doing that in our asset class? I'll postulate somewhat cheekily that as an industry, we're pretty poor in understanding the risks in our business. For example, FX volatility in 2015 wasn't just an EM issue, though we gave it a lot of attention. The Canadian dollar depreciated twice the rate of the Indonesian rupiah. Our basket of over 30 currencies in countries in which we invest, the depreciation was significantly less than that attributable to the euro in 2015. And GDP growth in emerging markets was still twice that of developed markets. So oil at $40 is frankly good for a majority of these markets. And I may be preaching to the converted here, but the country risk facts that everybody points to have very little meaning in private equity. Simply put, again, we invest in companies, not in countries. It's about the micro, not the macro. You have to choose companies that are vastly different in risk profile from the country in which they operate. And remember, companies that are growing at 30% per annum can pretty much outgrow any risk that we can think of. Of course, there will always be left field risks that we need to be concerned about. We need to assess whether they impact the companies that we choose rather than the countries in which they are based. And going back again to a point that Philippe mentioned, was the Arab Spring bad for business in Egypt or Tunisia? That wasn't our experience. That wasn't our investors' experience. Of the 6 regions in the world that we operate in and have invested in over the last 5 years, North Africa arguably has been the best performer. Strange, but reality. Let's turn to elsewhere in Africa. Does the presence of Boko Haram in the northeast of Nigeria make Lagos an uninvestable destination in the southwest of the country 1,000 miles away? Of course it doesn't. Lagos has more in common with Accra in Ghana than it has with the north of its own country. Are people in Turkey still consuming milk and dairy products despite the madness of their president? Of course they are. Should we lump Mexico and Peru in with Brazil and Venezuela for PE investing just because they're in Latin America? Of course not. These are the systematic thought processes that we all have to go through in order to understand where opportunity is undeniable, drill down into where opportunity is exciting, and then find those gems of companies that all of you look for to produce returns. As PE investors, we all get to choose between markets, between cities, between subsectors, and ultimately between companies. So from a market perspective, we need to be patient. We need to reevaluate opportunities continuously as assets reprice, and we need to be prudent with our due diligence. So in summary, when you're not in our markets, there's a tendency to describe them in a certain way that is divorced actually from the reality that is experienced by those of you in this room that are focused on the private equity opportunities. A tendency to look at GDP growth for those people, when actually we should be looking at consumer growth. Look at a scooter index, don't look at a GDP number. A tendency to look at countries when we should be looking at markets and cities. A tendency to look at markets when we should be looking at companies. And a tendency to equate investing in one sector to investing in another. The list goes on. And part of our job, part of our collective responsibility of everyone in this room is to push back on those narratives about our markets, especially as it relates to private equity. It's important to say that because when investors look at these markets, they often take the view, okay, quickly, let's invest in the public markets. That's the worst outcome because those public markets are actually not representative of the real underlying economies in those countries either. And the very simple fact there is if you look at all of these markets put together, and if I can take license again for being on the stage, they're probably less than the market cap of Google. And if you then disaggregate and think to yourself, well, let's look at a market in a particular country, probably half of it is dominated by 3 or 4 countries, and probably most of them are either banking, telecom, or commodity driven. So let's go back to private equity and the real drivers of economic opportunity. Our investments, ladies and gentlemen, are extremely important because we can drive positive change as well. We can do well and we can do good. I've always said that to build a great company, you first have to build a good company. And a good company can only be built on what we all know societal privileges and normative expectations are, which means ESG, which means thinking around the impact that those companies can make in those markets, and arguably teaching them to think in a slightly different way about the same marketplace they face. One example I love to give is in a supermarket not many years from now, as a young person walks into the store and sees 3 bottles of water lined up and says, which one should I choose? I would like to postulate that he or she will pick up the bottle from the company that they know is having an impact in the domestic economy in which it operates. In the midst of all of this global uncertainty, the public markets continuing to remain jittery, valuations continuing to fall, capital hard to access. However, many of these markets that we live in, that we see, have fundamentals that are resilient and continue to demonstrate strength. And as I've said, private equity is a unique asset class in which investors can actually navigate choppy waters far more safely in search of opportunity. But that doesn't mean that we don't have a responsibility to calm these choppy waters. Our markets, no doubt, suffer from major challenges, including inequality, which I've kind of hinted at earlier, and that Philippe very eloquently talked about before I did. The private sector clearly has a role to play here. We have the opportunity as a private equity industry, irrespective of the market in which we operate, to have a lasting impact, to be able to do investments in a way that return value to shareholders and empower a large number of people in our markets to live life in a way to which they should be entitled and to which they have an inalienable right. You may think I'm running for political office. I'm not. I'm actually stating the obvious. I'm stating the obvious that in our markets, when you deploy capital, you have the ability to make an enormous difference, not just in the search of the bottom line and profitability, but actually in the reality that the dollar that you invest can have an outcome far beyond its capacity to generate profit. There is absolutely no reason why we can't do well and we can't do good at the same time. By deploying capital in a very smart way into smart companies, we can encourage wage and economic growth that outstrips wealth accumulation. We can encourage a better rule of law. If we have scale and as an industry we group together, and MPA is instrumental in that, if we can come together as industry groups and talk to governments about the need for reform and the opportunity to do things in a certain way, we can have a disproportionate voice in which industry is governed. We can promote better health outcomes. We talk about technology, and we talk about the way in which .com companies and e-commerce companies are changing the world. Well, ladies and gentlemen, they're going to change our world in a speed far faster than you can imagine. If you imagine everyone in this room, before you came in, gave a drop of saliva to someone standing outside, and the cost of testing it had come down to $10. By the time I finished speaking, we could have worked out that 99% of us, hopefully, would not get cancer or a serious disease. That makes the insurance industry redundant, because by and large, we can self-insure. Add that to driverless cars and you see where I'm going. But the reality is that in industries like healthcare, financial technology, and so on, the ability to create massive change through investment activity into the right companies, especially in markets that are going from 1G to 4G, is large, undeniable, and extremely exciting. So healthcare and industries like that continue to remain a great opportunity, as does the underinvestment in infrastructure and energy. The world is facing many challenges, ladies and gentlemen, on many, many fronts and simultaneously. It's not that it hasn't done that before, it's done that before and navigated itself out of it successfully. But whilst we talk today, inequality, unemployment, environmental challenges continue to dominate our thinking. And it's important for us not to forget that we have an important role as an industry, especially in our markets, to help overcome them. In the big picture, our industry is a small part of the effort that is required to improve our collective lot. But we all have a role and should embrace that role and be excited about the role. You're in this room because you chose to be in an industry that is exciting and innovative and can make a difference. You're in this room because you're good at what you do. And if collectively we start thinking like that and we push back on some of these narratives, what you realize is that investment capital will catch up with economic opportunity. And when the two are applied sensibly by yourselves across that large swath of geography that we've been talking about, then the opportunity to drive lasting change becomes impossible to stop. Personally, I've implored, I choose this word carefully, I've implored my own firm to adopt principles of giving back and, as importantly, to pass that on to all the partner companies in which we invest. This is the power of leverage. This is the power of true capital. So I hope that my thoughts have given you a useful perspective, a moment to stop, to slow down, to think, and to emerge, hopefully into a coffee break, with food for thought, with the idea that what we're doing is not only profitable, but it's important and makes a big difference. I hope that this perspective on our markets encourages you to share similar opportunities with each other and from this stage over the course of the next few days about opportunities, not about despair, about where we're headed, about the bright future. As business professionals, we need to be mindful of the big picture volatility, but don't be consumed by it. Differentiate as to where it's applicable and where it's not. Because our industry, ladies and gentlemen, is about pursuing nuances and selectively choosing investments. We have the choice in terms of what we do. And as global citizens, it's about thinking collectively and requiring all of us to have a positive outlook on where the future is. We have a responsibility, a real responsibility, to redefine even the use of the word private equity into and towards partnership capital, away from the word private equity and into and towards partnership capital, because that's what all of us in this room do. This helps us think more long-term. It helps us think how we can truly leverage the fantastic skill sets of not only the people in this room, but of those that work for you in industry across the world. The leaders of the global growth market investing community happen to be here. Together, we can redefine our markets, and we can live through the power of that opportunity. Markets where we allow the flow of people, the flow of capital, and trade, not deny it. This is the best time to be alive, according to a report that was issued by the Oxford Martin School last year. I don't know about that because I don't have any other choice to be alive in any other time. It's the only time that I'm alive, and I certainly hope to make the most of it and make the world a better place. I hope all of you do too as well. Thank you very much.